What's going on, guys? Today on the show we are talking about Microsoft. In today's video we are going to investigate Microsoft's numbers and figure out what they're doing right, what they're doing wrong, and find the intrinsic value of this company. If you are a potential Microsoft investor or you have a stake in this company, you found the right channel and you found the right video. Now, Microsoft has been making a lot of waves because of ChatGPT. It's been making headlines all around the world. It's the first AI search engine, and currently this stock price is up today by 3%, but over the last year it's been on a little bit of a decline. Now, if you are like me and plenty of other value investors out there, this is where things get exciting, because ultimately, folks, we're trying to find great companies at great prices. Microsoft is a phenomenal company. However, does the price make sense? This phenomenal piece of software is what I use to investigate companies quickly and efficiently to get the whole scoop of what they're doing. The software is grading the company a 9 out of 10. That's a pretty good score. They're only getting knocked in 1 point, which is the price to earnings ratio over the last 5 years, sitting at 35%, where we want to find companies ideally underneath 22.5. That's much more of a fairer multiple. 35 is more of a premium, but Microsoft's been making a lot of waves, guys. Apart from acquiring OpenAI, they're looking also to acquire Activision for their front video game sector with Xbox. This 35 price to earnings ratio, even though it is a premium, might be worth it if they can justify that. But it's currently sitting at a $2 trillion market cap. It's hard to say at the current moment. However, 9 out of 10, phenomenal score, and they're getting a lot of things right. They have a high current ratio sitting at 1.93. The return on equity is sitting at a whopping 36.53. So current ratio, they have a lot of assets on hand to cover those liabilities, which we love to see. High ROE. EPS growth is up over the last 5 years. Low debt to equity sitting at 35%. I'm just flying through these numbers, folks. These are all important things to take a look at. Debt to equity is great because ultimately we want to find companies that are leveraging their capital through equity, not through debt. And better yet, as it's below 50%, they are also buying back shares. Not by a huge amount, just by 0.68% of shares have been bought back over the last 5 years. So if you're holding on to this company, this is great, and for potential shareholders, also great. The net income is up, free cash flow is up, return on invested capital is exceptionally high at 23.97%, and the revenue growth is up by 17%. Looking pretty good. I like Microsoft. I like the numbers. I think everything is looking happy-go-lucky, and they're making all the right moves in the tech space. They've been making huge amounts of numbers. So take a look at this. Even in their company metrics category, their trailing 12 months price earnings ratio is currently 30. So still on the premium side, but look at their EPS on the trailing 12 months. It's 9.02 compared to an average of 6.18 and an average price earnings ratio of 35.09. Now, you do a little cross comparison over here. The return on equity on the trailing 12 months is above their 5-year average. Same with their profit margin. So it's all looking happy-go-lucky. They do pay out a dividend, folks, of 0.93%. Very small baby dividend here, with $18.1 billion allocated to paying out that dividend. And since their average free cash flow is $47.4 billion, you don't have to worry about them not being able to pay that dividend. It's easily covered. And the trailing 12 months free cash flow is $59 billion. So the numbers are all looking good. They can pay off their dividend. Their revenue's going up. EPS is going up. They have a high on return on invested capital. This company is looking like they are able to justify that high price earnings ratio that I mentioned early on in the video. Now, what is this company worth? Well, lucky for me and lucky for you, this software here has an intrinsic value calculator. It's under the price analysis section. If you want to get your hands on this software, folks, follow the links in the description box below. I'm pretty sure you will love it. 7-day free trial. And if you're enjoying this video, hit that like button and subscribe button. Now, watch this. And apologize if I'm flying through this, but this is how quick the software is. Makes everything easy to understand. What I did here, folks, in the price analysis section, I did 3 different assumptions of what I believe this company can do over the next 10 years, utilizing these historic numbers that they've shown us over the last 10 years, right? So with the revenue growth, I took an extremely conservative approach by going 5, 6, and 7%. Everything else pretty much stayed the same with the profit margin, free cash flow margin, and I took a conservative approach on their price to free cash flow and the price to earnings ratio. Now, as I said, revenue growth, conservative amount, because look, even though OpenAI might be able to bring in new forms of revenue and increase the revenue growth over the next 10 years by God knows what, I have to be conservative because I'm only using what I have on the table right now, and they are a $2 trillion company. Hit calculate, and we're going to find out what we should be paying for this company today. I'm very excited to see what happens. So software is going to run through all these lovely calculations. Current price is $272.32. Now let's see what we get spit out here. All right, so a little bit lower than what I'm thinking of, but look, $164.91 is the average price calculation. So what does that mean, folks? If you believe in these numbers here, ideally this price needs to fall down to $164.91 for this company to be making sense. Look, I like Microsoft, and honestly, it makes a little bit of sense here considering the price earnings ratio is 30. Now you split that price in half, right? Call it 300. Let's say we call it 300, right? Dollars, obviously giving a little bit of a buffer. It would be pretty much around this price range here, as it would fall into between this conservative and moderate average. That is much more of a fair multiple to pay. So my thoughts on Microsoft: phenomenal business. The numerics make sense. They have a lot of different things happening for them going forward. However, the price just doesn't make sense right now. And that's the fact of a lot of companies right now in this economy. We've had an incredible bull run going over the last several years. As prices keep dipping and going south, this is where you get to look at the companies that are providing the most amount of value. Microsoft is definitely one of those companies. However, the price is a little bit too expensive for what they're actually putting forward. Not saying they're not worth it, but we don't want to overpay, is what I'm trying to say. Anyways, folks, that's the video. If you found this video helpful, share it with a friend. I will see you in the next one. And make sure, if you want to watch any other analysis videos, check out this playlist right here to not miss out on any of my other analysis videos. You should definitely hit that like button and subscribe button. I will see you in the next one. Thank you so much for watching.